Good afternoon, everyone, and welcome to the 7th installation of our COVID-19 webinar series, presented in partnership with some of our most valued Gold Associate professional member firms. Today, we are joined by Dean Snyder, Managing Director at AFS, to discuss credit and corporate lending and the impact of the COVID-19 crisis, including on the transition to LIBOR. AFS is an industry-leading provider of lending and risk management solutions for financial institutions, and I know that many IIB members utilize AFS lending risk management services. As a reminder, all participants are muted, but we encourage you to submit questions through the Q&A function on Zoom or email them to us at info@iib.org. As per our usual practice, following today's webinar, we will email all of you the slides and a link to the recorded session, which will be available on our YouTube channel in the members only section of our website and on Zoom on demand. Dean, thank you so much. We are really looking forward to hearing from you on one of the most urgent and critical COVID-19 related topics, managing credit risk. And with that, I'll hand the virtual mic over to you.
Thank you very much, Bridget, and welcome everyone for today's webinar. Again, I'm Dean Snyder. I've been with AFS, believe it or not, more than 35 years in the commercial lending and technology business. AFS itself is celebrating 50 years in the business. It's quite an accomplishment, and we've had the privilege of having quite a stellar list of client banks over the years, to name a few: U.S. Bank, Truist, Wells Fargo, Citi, many foreign-owned commercial banks such as Santander and BBVA, City National Bank, now part of RBC, Bank of the West, part of BNP. So if you're not familiar with AFS, I encourage you to go to our website and you will learn more about what we're doing in the industry at afsvision.com. Today, we'll talk a little bit about what AFS has been doing to weather the COVID-19 crisis. We'll also talk about the government action through the CARES Act and P3, Main Street lending, and so forth. And then we'll also talk to you about the transition from LIBOR that is still going on amongst all of this other turmoil, and give you some firsthand reports about the ARC committee and where the industry is in that transition, and then talk a little bit about some of our information services as well. So as far as AFS goes, we, as you know, are a technology company, right? Have focused on lending, and primarily commercial lending, the process of commercial loans, the information around those. And so as a technology company, as you might expect, we continue to invest in our own infrastructure. We're a regulated software vendor in the financial services industry. And believe it or not, back in December, we ran a test to see, unexpectedly, if everyone needed to be remote the next day, could we continue to operate? So it was a well-timed practice session. So of course, when the quarantines went into place, AFS did move into a fully remote operation, which all of our employees, and we're based just outside of Philadelphia, and we have some employees in other states, but primarily in the Philadelphia area. But we have been 100% remote back to mid-March, and have had no interruptions in our work with our clients. And in fact, and I think others will attest, we've actually seen some productivity increases as a result of the remote work. Part of our work is also on the LIBOR transition. And again, I will give you an update in a few minutes about those specifics. But we've been able to continue with that LIBOR transition uninterrupted as a result of the COVID-19 crisis. There, as we say, have not been any changes to our delivery dates or any of our project work that we are doing. So today we thought we would talk a little bit about the CARES Act. I know most of you have been reading a lot, have been involved in this firsthand over the last 3 to 4 months. So just a little summary and kind of level set where we are. We know the CARES Act that was passed by our government, and it says 2.1 trillion in support. I think as you count up, it's up to maybe 3 trillion. If anything, and I worry we're getting a little numb to numbers of billions and now talking trillions based on what's happening with our economy. So the key sections of the CARES Act by title, Title 1, of course, was the Paycheck Protection Program and some additional financial support from the Treasury and the Fed. Titles 2 and 3 I did not list here, but they had to do with the stimulus checks that went out, unemployment compensation support, some of the health care changes and so forth. That was Titles 2 and 3. And then, of course, Title 4 was focused on the stabilization of the economy, providing additional assistance in many different ways, assistance to the banks to enable them to provide new opportunities for lending to businesses. And of course, we'll talk about the P3 program as well as the Main Street lending program. Now, the Paycheck Protection Program, as we know, initially went out, and there was quite a flurry of activity of the nearly $350 billion that was made available primarily to small businesses. And of course, then there was a subsequent replenishment of some of those funds, another $310 billion. So through the end of May, there was the total available had been the $659 billion, right, to businesses. The act went into effect, and then there were revisions to that. And so key revisions that went in the end of May, which one, it extended the period of coverage for these P3 loans to cover expenses for businesses. Originally was going to be 8 weeks, and of course it was expanded to 24 weeks. Again, as the whole COVID situation unfolded, right, things continue to be changing, and the government, of course, was taking as many steps as possible to keep up with those changes and really to keep our economy moving and not going into a more extreme fallback. So some of the things that happened to the P3 Act as it went along was originally there were deadlines for the end of June, and they've been pushed back to the end of December again as the quarantines have been extended, the lockdowns and so forth. The dates for the program have been extended as well. The government also changed some of their forgiveness parameters. So originally, what was covered for eligible expenses for your P3 loans originally was going to be 75-25% ratio. How much of your expenses had to go towards payroll? Because remember that one of the key goals of the P3 program was to keep people on our payroll. But there was some flexibility extended so that the non-payroll expenses could be a higher percentage, and it went to a 60-40% breakdown. And of course, the forgiveness program, the idea that the businesses could then apply for forgiveness of this money that they borrowed. Originally, that any money that was not forgiven was going to carry a 2-year term for repayment, and that's now been extended to a 5-year repayment term for these loans. So as of last week, I guess June 19th, we've updated the numbers, and you can see, starting the second row, as of April 26th, you see 1.6 million loans and 342 billion in net loan balances, and the average was about 206,000. And you see the number of lenders. Now, as of last week, and actually, I guess as over the weekend, we got updated numbers to show you that the total approved loans is approaching 5 million, over 500 billion in dollars. Notice that the average loan size has come down, because I think as people understood the program better and some of the rules were relaxed, it opened the door for some smaller companies to take advantage of the P3 program, which is why you see that the average loan size also decreased through the end of June. Now, interesting enough, not all of the money has been utilized, and as I said earlier, 659 billion in total money available. It looks like about 140 billion is still remaining, still not been utilized, or dry powder that's still available there. However, today, ironically, the date of this webinar is the expiration date for any additional applications for P3 loans. So June 30th remained the expiration date for new borrowings. So as the program has continued to unfold, there have been 19 interim final rules. There's an FAQ section that has over 48 questions and answers. So it's, again, the program continues to change and adapt, based on the appetite by the borrowers and by the banks and the lenders. We've gone through a lot of phases. In the beginning, I think a lot of you heard about the public outcry where some large companies were perceived as taking advantage of this P3 program. And in fact, once that information got out in the public, I think there was some public pressure, and a large portion of that was actually returned by those companies. There's additional, pressure on borrowers, right, as far as, what are the terms and conditions for this money, as much as the government is trying to make it as easy as possible. We all know that there are, unfortunately, some that look to take advantage of any of these situations. So the SBA is going to be reviewing all loans over $2 million. So they did set that threshold, and then any recipients that are over 150,000 will be disclosed publicly. Now, to know the number, the over 150,000, I think, is about 15% of all the loans. So 85% of the P3 loans are less than $150,000. And in fact, I believe yesterday there was a bill introduced through the Senate to automatically grant loan forgiveness to all loans under 150,000 without the borrowers having to go through the forgiveness application process. And that was a bipartisan bill introduced by both a Republican and a Democrat senator, as I understand it, that I think would help a lot because the loan forgiveness ruling, the interim final ruling issued May 22nd, had a number of procedures or whatever that have been scrutinized. And of course, the borrowers' willingness to say this is quite onerous. The borrowers are already dealing with the obvious issues of how to maintain business during the COVID quarantine and so forth, and shut down the businesses. So they're having to deal with that, and then to be given a long, I believe, 11-page application to file for the forgiveness was obviously not well received by the borrowers or the banks, for that matter. So the SBA has done an easy loan forgiveness, a new form where they reduced what was 11 pages, but they reduced it to 7. So I'm not sure if that still qualifies as easy, but certainly better than the original forgiveness process. So as we work with our banks here at AFS, we understand that there is a lot of activity going on with the banks and their borrowers to go through the forgiveness process. And of course, it's going to depend on when the P3 loan was issued. Again, prior to June 5th, they were done on an 8-week covered period. And then after June 5th, it was expanded to up to 24 weeks. Now that also expanded the time when borrowers could apply for the forgiveness. Okay, so they have, I believe, until the end of the year to do that filing. There was additional legislation, of course, issued to really focus help or assistance on very small businesses and minority-owned businesses and so forth. The next to last bullet here, you'll see there was a prioritization for what's called prioritize community development financial institutions. So CDFI is another acronym that's been added to our world as a result of this process. And as you know, there's continues to be political action, I guess, by Congress around maybe additional stimulus checks or payments and other ways to help the public. And of course, with this being an election year, there's certainly a lot of activity to try to provide assistance. Someone did ask if we had an idea of when the recipients of the P3 loans would be disclosed. I don't have an answer to that. We can certainly look into that and see what that timeline might be. Now, moving on to slide 8, this was an interesting chart that we saw. This was presented by the president of the Boston Fed in a speech recently, which shows you a graph of the number of COVID cases per 1,000 in the population, right, going across, and then going up the unemployment rate. So interesting that you see that the United States has a high percentage of COVID-19 cases and also a very high unemployment rate. And so there's a lot of theories that go around this data. Of course, you know, you could argue that in the United States there has been a stricter lockdown of businesses if we go back to the beginning stages of March and April, which could result in more effect on unemployment, right? But just interesting to see how we compare to some of the other countries, especially if you look at, you know, like a South Korea, Japan. Now, they did go through a pretty strict lockdown, but they were able to, I guess, have fewer cases and to have less effect on the unemployment. And of course, another effect on unemployment could be, and more restrictions outside the United States in doing less, attribute to some countries like France and Germany with lower unemployment rates as a result. I'm just going to double check that everyone's hearing me okay. I'm getting a message from my provider about my internet signal. We're still good, Bridget, as far as I know?
We're still good. Yeah, there's a little bit of in and out, but we can hear you fine and we can see the slides. Thanks.
Okay, thanks. So I'm going to move on to slide 9, which is the Main Street lending program, right, that opened up earlier in the month. And again, this was an effort, or is an effort, by the Fed and the Treasury to provide more assistance to businesses. Some of the businesses that were too large to qualify for P3 or had other reasons to be ineligible or needed, just additional financial support. So there were 3 different types that have been introduced for Main Street Lending Program: the new loan facility, priority loan facility, and expanded loan facility. You can see in the chart, they all carry a 5-year term. They have
Dean, you're
principal
cutting in and
payments,
out
deferred
now.
interest. The pricing would be based on SOFR. Okay. How's that? Is this better?
Yes, that's better. Thanks.
So again, there was some concern when the original guidance came out to say that the interest rates on the Main Street loans would be based on SOFR. I think it was partly an encouragement by the Fed to encourage the transition from LIBOR to SOFR. But there was a little bit of panic, I think, amongst the lenders saying, we're not ready for that. So there was a revision, and the terms were changed so that the pricing for the Main Street lending loans could be LIBOR-based and did not have to be SOFR-based. These are not forgivable loans like P3. They're much larger loans. And more importantly, they're going to be backed by an SPV set up by the Fed, where they would purchase 95% of the loan back from the lender. And there are fees, service fees, and so forth associated with those. Prepayments are allowed. And of course, there are still some limits on the size of the borrowers who can apply for the Main Street lending. There have been a lot of mixed reaction to this, and I think some slow adoption about Main Street lending, again, as the effects of the pandemic continue to be felt. A question about whether this is the best program for borrowers and for lenders at this point in time. So I think the jury is still out in terms of how much this will be utilized, how effective will it be. The lenders did have to register, and I think in the first week, over 200 financial institutions did register to be a lending party to the Main Street lending program. So we thought for today's call, this would be a good question to ask you, if you don't mind taking this poll, which is, does your bank plan to participate in the Main Street lending program? So go ahead and vote for that. I think they have to open up hosts and panelists cannot vote. I'm reading the fine print here. So please go ahead and start your voting. Are you planning to do Main Street lending? Are you not? Or is it still something that's undecided in your institution? So Bridget, I'll let you open up the polls, and you can let me know when we have some results that we can share with our audience today. Okay, so we have some results now. Interesting, as I said, there's been some concern about the effectiveness of the program, and that seems to weigh out with some of our respondents, that 60% were saying they're probably not going to participate, only 30% are planning, and 10% that are undecided. So thank you for your participation. It gives you an idea of what might be happening in the industry. So to summarize, you can see there are many different efforts that have occurred by the Treasury, the Fed, Congress, to help stabilize the economy as we go through the pandemic. And you can see, the different liquidity facilities that have been offered, some at the corporate level, small business level, and so forth. And again, when you total all these up with the CARES Act, it comes to as much as $3 trillion in investment backed by the Treasury to help stabilize the economy as we get through the COVID-19 crisis. So I'm now going to move over to a different topic, which is the LIBOR SOFR transition. And AFS was invited to participate with the ARC committee in their bank loan operations working group. So we have been able to be at the table and see firsthand the discussions and so forth around this event. And I think the first face-to-face meeting amongst the ARC's working group occurred in January of 2019. I don't think any of us imagined when we were sitting in that boardroom up at Wall Street that we'd still be 18 months later, still be looking for some decisions and guidance on how to transition away from LIBOR. But in fact, that's what's happened over the last 18 months. There's been a push to create guidance that everyone can agree to. So you've had, leading financial institutions, banks, you've had major vendors like AFS, all participating along with the Fed, along with the lawyers and so forth, to come up with the right guidance, the right rules, so that this can be a smooth transition. So that has been occurring. As we know, the date for LIBOR cessation has not changed. That's still the end of 2021. That LIBOR would no longer be published, but there's been a move, of course, for the markets to be moving sooner and to adopt new alternative reference rates. So certainly SOFR has been the identified alternative rate here in the US for US dollar contracts. And we've seen, of course, in other countries, we've got the Ester rate in the EU and the Sonia rate in the UK, and different rates by currency in different markets. And we're trying to, the markets are trying to coordinate as much as possible for consistency purposes so that this becomes a global process, certainly a global transition. There have been a lot of specific questions around just doing SOFR and different ways to calculate SOFR. We've all been learning now about compounding in advance, compounding in arrears, forward-looking rates, and so forth. We learned about something called observation shift, which is if you're compounding, what do you do around weekends and holidays and counting days and so forth. So some of those things have finally been settled. Most recently, the ARC has decided that for SOFR compound and arrears calculations, there would not be an observation shift. So that's been helpful for AFS and the other vendors as we continue to adjust the code in our loan accounting systems to make sure that calculations are done correctly, to make sure borrowers get accurate statements, to make sure parties and syndications get accurate and understandable notices and so forth. So there's been a lot of work continuing in that area. And the guidance is finally taking shape. We're seeing various issuances from the ARC over the last few weeks, quite literally. Another issue that's come up as the COVID-19 effects on the economy have been what's happening in rates, and it's brought back the whole negative rate topics. And the ARC has been working with the lenders to employ better floors so that ideally we can prevent certainly loan rates from going negative, even as index rates are dropping below zero in certain markets. So there is continued talk. And again, I think that the ARC's working group is coming to agreement finally on how flooring would work in the various contracts that deal with SOFR. So that guidance is being released, I think, as we speak. Again, as I said, we've been talking with the other markets. So certainly over in Europe and the UK, the Financial Conduct Authority has been issuing their own statements. And one of the big questions was with COVID, would any of these dates be pushed back? As I said earlier, the LIBOR cessation is at 12/31/2021. That is not being changed at this point. Everything is still in place, and that will still be formally in effect at the end of next year. The markets have been trying, the regulators have been trying to push the move of contracts and so forth to be earlier. And back in December of last year, the FCA and Bank of England came out and said, we'd like the transition to SOFR to start third quarter of 2020. Again, that caused a little bit of a shock within, I think, the industry, where they were thinking we had until the end of 2021 to realize, wait a minute, this thing needs to happen earlier. Well, this is one date that did get pushed back a little bit as a result of COVID. And so rather than the third quarter of 2020, they've pushed back their recommendations to be first quarter of 2021. So I know the vendors like us at AFS are working to release new code capabilities to our own accounting systems. The banks are looking to test and get that implemented over the next few months so that by early next year, early first quarter, yes, of next year, the banks would be well positioned to start actually doing the transition from LIBOR to SOFR. I mentioned before that the Main Street Lending Program is not going to require SOFR. So they're still going to allow LIBOR for a period of time. That was a change as a result, I think, of pressure from the ABA and other associations, as well as some of the major lenders. And then also, as we look at using SOFR as the alternative rate, again, I mentioned this compounding and arrears calculation. Ultimately, the market was looking to establish a forward-looking term SOFR rate, which has not yet occurred. And so it could work more like LIBOR. So you could have a 30-day SOFR or a 90-day SOFR or 180. But right now, since it's a daily SOFR rate, they're using the compounding and arrears method that's been adopted by ISDA. It's being used for your swaps. So again, this is causing a need for the lenders, the banks, to upgrade their systems to be able to support the new SOFR rates, especially if they're doing the compounding. But there's actually 4 different methods for using a SOFR rate. Only one of them is the compounding and arrears. So the banks I know are looking at which methods they would be preferring to issue. We show you here that the SOFR rates are being published. If you haven't looked at them, there is a page for the New York Fed's website where you can see what the daily SOFR rate is and what the averages that are currently being calculated. Again, there's still a lot of fallout, I think, that's going to occur as the market moves to SOFR rates, being daily rates, knowing, not knowing today what your rate is. So if you wanted to borrow today, so there has been an employment of a look-back period parameter that therefore, the borrower would know on a given day what their rates are going to be by using X number of look-back days. So there's also the question about sending the borrowers a billing statement at the end of their interest period, and you're wanting to send that billing statement, say 5 days, 10 days ahead of time for the borrower to see. But if the SOFR rate is being done on a daily basis, then you've got a challenge where you don't know what the rate's going to be 10 days ahead of time. So again, banks are looking at how to deal with that, whether they adjust when they send out bills, they put billing adjustments on the next bill, how to explain that and so forth. So there's still a lot of activity around the operational aspects of doing the SOFR daily rates. So I think we have another polling question, Bridget, at this point, as we finish up talking about SOFR. How prepared are you? Are you prepared today to issue and surface SOFR-based loans? A little bit hard to answer because there are 4 different methods, right, to use. But assuming you're going to use any one of the 4 SOFR methods, are you prepared today? Yes, no, or almost is the question. So please go ahead and cast your vote, and we'll see. As I'm looking at some other questions coming in, we'll see what the results are going to be. Okay, do we have some results? So again, as expected, wow, nobody's ready today for SOFR. 60% said no and 40% said almost. And I think that does align with what we're seeing in the industry as banks and vendors are sending out updates and banks getting ready to that. So it's going to be a very interesting 6 months, not just with what's happening with the economy, what's happening with businesses opening or shutting down, but also the timing of the transition to SOFR, what's happening in the bilateral loan space versus what's happening in the syndicated loan space. So I'm going to move on to mention from an AFS standpoint. I mentioned before, many of the major commercial banks are using AFS systems today. So we have been having regular webinars with our client banks, letting them know where we stand with making sure our systems are complying with the guidance for SOFR. And we've also been sending out surveys. We've got an upcoming webinar, I think on July 8th, and we'll be providing the results of our latest surveys around bank readiness, what types of SOFR contracts they're going to be doing, what kinds of terms, and so forth. And you'll see our changes are rolling out over the next couple months so that banks can be preparing in the 4th quarter. And I think mostly it looks like 1st quarter of 2021 where they would actually be either issuing or participating in SOFR contracts. So that's a quick update on where things are from an AFS perspective around SOFR. I also wanted to mention that AFS has had a partnership for more than 15 years with the Risk Management Association. And hopefully some of you are familiar with this and the information that we're able to collect from our client banks and provide data to the market along with the RMA, doing some analysis to see what's happening, certainly in the area of credit risk. And so you'll see here we issue a newsletter, and you'll see examples where we can give information about credit quality, past dues, impairments, charge-offs, so forth. We can show you what's happening with that credit quality over time. We can show you what's happening with delinquencies, and also from an industry perspective. And again, this information had been done on a quarterly basis. We've just moved that up to be done on a monthly basis because we know as things are changing more dynamically, having that on a monthly basis is going to be more impactful and more beneficial. And we have analysis to show you things like drilling down into the energy sector and what's happening with that over time. Commercial real estate in the lower left, of course, is a big question. What's going to be happening with commercial real estate? What's happening with office space as more and more companies, banks and other financial institutions or any companies are learning to work more remotely? What does that mean to the need for commercial office space? What's going to be the effect there? What's it mean to certainly retail space if people are not able to go into stores to make purchases and so forth? And you'll see the map in the lower right quadrant. We obviously can also give you the analysis by geography as well. I'm going to take a minute to look at some of the questions that we have. Are the results of Main Street use similar to U.S. banks? And well, how do you explain the lack of interest by the lenders? Well, I think, again, it depends on the situation. We know that there was a large drawdown of facilities early on in COVID. So the borrowers, companies really had been flushed with cash as a result of that. We've also seen, if you're reading the news, quite an uptick in deposits that are being held by banks. So banks have other options for lending. They may not have to use the SPV of the Main Street Lending Facility to do that. Someone asked about the long-term impact on credit for COVID-19. That would be a great, if I really wish I had my crystal ball, I could tell you what that is. But again, with our services with RMA, we're going to continue to provide you on a monthly basis what's happening in the market relative to credit, relative to pricing. How should you prepare to handle downstream impacts? Well, I think everyone's doing that now. They're learning to adopt. I think the American worker has done quite well to deal with the situation. I know that the impact has been very difficult on some, certainly more difficult on some than others. We at AFS, we've seen actually an increase in productivity during the time because, quite honestly, people are home and you want to say, what else do they have to do than to work? But part of it is because they're not going out, they're not going places, so you have more time. But I don't think that's a sustainable situation. So it's going to be interesting to see how we move. I know from the banks that we deal with, they've taken steps to help their employees be remote. I've heard of banks issuing stipends for employees to outfit their home office. Banks sending large monitors, large screens to their workers so that they can have dual monitors and work in a more business-like situation. So there are a lot of steps being taken to try to deal with the situation, not knowing, unfortunately, how long this is going to be. And again, I happened to be in a doctor's office this morning, and I made the comment as I'm leaving, hope, we can get back to normal soon. And of course, that's the big question is what is normal? It will probably be something new for all of us. That is the end of the material that I have today. I'm looking to see if there's any other questions that have come in. As far as talking about terms of credit risk in the market and what we're seeing, well, I think, we have some recent results from May, looking at the data that we get, and we get data from many of our banks. So we have, nearly 1 million loans, commercial loans in the database. We're seeing for the month of May that the loan growth has been very flat, but a little bit of uptick in the P3 loan activity, but a corresponding downtick in regular commercial loan activity. So the numbers are relatively flat for May. Certainly new renewed loans are down. Financial spreads are up and fees are up. So that gives you an idea of what's happening with the market.
Okay, Dean, quick question. I know that the stress test results just came out and the banks did well, but one of the things that was noted was that they had not really taken into one of the reasons for kind of an ongoing stress test process, or encore, I guess, was that even in the sensitivity analyses, they had not really taken into account the effect of the Fed's program and Fed's programs and fiscal stimulus. Do you have, any sense of how significant that has been and might continue to be, just kind of from the, credit risk overall market standpoint?
It's a good question. The markets are quite resilient, right, in dealing with all different types of issues, and certainly we're not necessarily prepared for a specific scenario like COVID, but in terms of just overall impact on businesses, downturn in businesses and so forth, it's not totally out of line with what some of the stress test requirements had been. So we're seeing banks adjust to that, you know, fairly well from what we can tell. And as far as, you know, their capitalization levels and so forth, what we're seeing is mostly that that the banks are going to be able to weather this and weather through this. You know, that's the general consensus that we've been seeing.
Great, thank you. Any other remarks, or I think we've gone through all the, oh, there's one more question. Are you seeing significant changes in credit modeling at institutions? How are they adapting to the changing assumptions?
I think, and it goes along the lines of your previous question, yes, they're adapting, but again, if you look at it, it's what's happening in what segments of the industry, what's happening in which geographies and so forth. So to some degree, the lenders have always had to deal with those factors. Maybe some of them are more extreme with COVID or whatever, but I think, you know, the banks are well positioned to do this because it's not totally new. The important part, I think, is having data, having the data to know, as I said, what are the impacts going to be on a particular business or geography and so forth, a particular industry. I think having that information is going to be key. The process of adjusting credit standards, I think the banks are pretty good at doing that, but it's understanding what's the impact specifically to COVID, what's that doing to the economy and to the borrowers. So. Great.
Thank you.
So again, yeah, I would just like to close, say on behalf of AFS, we thank you for the opportunity. Again, we hope everyone is staying safe and well, and for those who have been impacted or lost loved ones, you know, our hearts go out to everyone as we get through this crisis. So, but thank you very much, and appreciate you spending some time with us today.
Well, we want to thank you, Dean, and your colleagues at AFS for being a valuable partner and member of the IIB. Echo your sentiments that we want everyone to stay safe and healthy, and I hope everyone can have a nice 4th of July weekend celebration. Thank the members for their participation in these events, and look for the email with the recorded link. And with that, we'll end today's session. Thank you, everyone.